Welcome everybody to the webinar. We'll be starting in just a minute to give participants a few minutes to settle in here. Good afternoon, everybody. Thank you so much for joining us for this webinar on sustainable agriculture investing. My name is George Dyer. I'm a principal with the Intentional Endowments Network, and I'm very pleased to have with me an excellent group of panelists to share their expertise today. Next slide, please. We'll be hearing from Sada Geuss, investment manager at Trillium Asset Management, Maria Lettini, Director of the Farm Animal Investment Risk and Return Initiative, Don Wiviott, Partner at Sustainable Farm Partners, and David Miller, CEO of Iroquois Valley Farms. After a brief presentation from each of our panelists, we'll spend the remainder of the hour in dialogue amongst the group and responding to your questions. So please enter your questions throughout the presentation in the chat function in the control panel at any time, and we will try to get to as many of them as possible. This webinar is being recorded and will be on our website shortly after it's completed, so you can refer back to this conversation and share it with others, and we'll also make the slides available on request. Next slide, please. So just briefly before we dive in, for those of you who are not familiar with the Intentional Endowments Network, it is a nonprofit peer learning network designed to support endowments in enhancing performance by aligning investments with institutional mission, values, and sustainability goals. We do this in a variety of ways, including hosting in-person forums and meetings, facilitating peer networking, curating useful resources on sustainable investing opportunities, and providing educational venues such as webinars like this one. So we encourage you to stay engaged in these conversations. And if your organization is not already a formal member of the network, we encourage you to consider joining. It's a great way to demonstrate your organization's leadership on these topics, and is also critical to making these types of offerings possible. More information is available on the website. You see the link there, or you can reach out and contact us at any time. Next slide, please. So again, we're very pleased to host this conversation on investing in sustainable agriculture. It's a very important topic. Many of the participants, endowed institutions in the network are colleges and universities that are always thinking about these big challenges facing society. And so many of them are tied to agriculture, from feeding the world's hungry to issues around clean water and access to water, impacts on the land and marine ecosystems, and much more. So we've increasingly been looking at the Sustainable Development Goals that you see here as a frame for thinking about the kind of key material issues that long-term investors really need to be considering. And so in addition to Sustainable Development Goal number 2, which you see here is zero hunger and is the one that kind of directly relates to sustainable agriculture, these topics that we'll hear from our presenters today really play a big role in considering several of the other Sustainable Development Goals as well. So with that, we can go to our next slide, and I will turn it over to our first presenter, Sada Geuss. Sada, take it away.
Great, thanks, George. Thanks for including us in this call. As a brief background, Trillium Asset Management has been investing in sustainable investing with full integration of environmental, social, and governance considerations into our investment process since we were founded in 1982. So we have a 30-plus year history of looking at a variety of issues, sustainable food and agriculture being one of those. This month, in conjunction with several other investors and the independent Croatan Institute, we published a paper specifically looking at impact investing in the sustainable food and agricultural space. This is part of a series of papers we've worked on with a number of other investors and Croatan under the theme of total portfolio activation. So the first paper came to be in August 2012 and really came from an interest from institutional investors to have their mission, their overarching goals reflected in how they were investing their portfolios. But for many, there just wasn't the education and background, and their financial advisors and consultants weren't providing them the information they needed to look at that in the broadest terms. So for many, they may have made the move to go to a Trillium that was doing public equities and fixed income. And integrating those issues there, but weren't able to move outside of that to other asset classes like private equity and private debt and real assets, and seek out opportunities across the portfolio. So this recent iteration of the paper looks at that with the lens of sustainable agriculture, and where we have the ability as investors to have that reflected. I'll say at the front, this paper is available on our website. It's also, I know, kind of a front page on the Croatan Institute. So I would highly recommend that everyone, access that. I think it's a really useful tool when we're thinking about these issues. Next slide, please. So I'm just going to highlight kind of high level what we talk about in the paper and kind of the framework we got to in the specific area of sustainable agriculture. So the issues that we're thinking about when we're talking about this space really go across multiple environmental and social issues that our clients are considering. And we've worked on this issue across those spaces. So it can be animal welfare, it can be indigenous people's rights, it's clearly climate change, right, on the bigger basis, it's access to food, and ensuring that people are not food insecure. And so there's a lot of places to look at how we can have that impact, and we tried to frame it out in kind of sleeves and themes that address the multitude of issues that you may, as an investor, be looking to address through your investments. So you see here, we're looking at sustainable production. What are our inputs to the process? Are we using pesticides in a reasonable and thoughtful way? How are we harvesting timber? What are we doing kind of in our production standards to improve those? Clearly, animal welfare. Are we moving away from factory farming? Sustainable consumption. Promoting better eating habits and populations, companies that are promoting healthier foods, clearly strong food safety, on GMOs, limited use or labeling around GMO just from an educational perspective, and food waste. And I'll speak a little bit about food waste later since it's a big space that we've been working in, because in the United States, 40% of food that's produced doesn't end up on a plate. And that's a huge issue from just a resource waste perspective, and also food insecurity and making sure that food gets to folks that need it. Smart agricultural technology. So this is really using ag tech and that space to improve our practices, to efficiently use resources. And a lot of the sustainable agricultural technology can help address issues in these other thematic sleeves. Conservation and climate change, as I said, proper land management, mitigating greenhouse gas emissions, using forests as carbon sinks. These are other issues that are incredibly important and tie into all aspects of what we're looking at. And then the social side, right? It's about promoting healthy eating. It's about being thoughtful in the production and promoting organics and using water resources properly. But it's also about the people that are in the labor markets and promoting fair practices to support small farmers, to keep slave and child labor out of the production, and to protect, local farmers against land grabs in big, large-scale commercial farming. Next slide, please. So where do we see the opportunities? We think in sustainable agriculture, you have opportunities to have impact in your portfolios across all the asset classes. For our review, we are looking at cash, public debt, private debt, public equity, private equity venture capital, and real assets. And I think this really covers a broad spectrum of investment opportunities. What you'll see here is that your least, your smallest opportunity pool is probably in public debt. There's very few options to have a just very directed investment in agriculture through the public debt markets. You'll find it sometimes within a broader fixed income instrument. So, for example, the World Bank could issue a green bond that in part goes, the funding will go to sustainable agriculture or supporting local small farmers. But there's not much that's very targeted and kind of 100% focused on the agriculture space. In public equity markets, which is where we do a lot of our work on reflecting these issues and working on them, you have a couple opportunities. It's in the portfolio construction and selection, so looking for better players in these spaces. We can be investing in small and mid-cap companies that are particularly in the ag tech space, so looking at companies that have really new products around irrigation, smart irrigation with low water use, companies that are working on recycling programs and cleaner or greener chemicals companies. We can also look at in that small and mid-cap space as well, but also in large caps, we can look at big food and beverage companies. We can look at the players that are doing the best kind of on a peer-to-peer level. And we can also work with companies through engagement on improving those practices. And I think in the public equity markets, it's really that twofold approach that is going to give you the biggest impact on your portfolios. Selecting an asset manager that is thinking about these issues in the portfolio construction, but also actively engaging, working in coalitions with NGOs and other active investors to bring issues to light at these organizations. That they can focus on and improve their practices around, because there's big impact when we get large companies to make incremental moves on issues around sustainability in their supply chain and their kind of distribution. From this chart, you'll see that really the biggest direct impact on the ground, 100% impact investments can be found in private equity, real assets, and private debt. And I know there's a couple other panelists on this call that will speak to a couple of those opportunities. But that's where you're able to, be directly supporting farmers buying, farmland or sustainably forest land, or investing in people that are looking to grow that space. And so, you have for most investors, the public equity and debt market is a big share of the portfolio, and you can certainly have impact there. But you have a much bigger direct impact opportunity when we do start to look into those private spaces. Next slide. So before I hand it off to Maria, I would just like to, kind of give a couple of examples of how we're doing this in portfolios where we are, again, investing in public markets. We look for good companies. So we're not investing in companies simply for an advocacy opportunity. But these are public big companies. And so there's always room for improvement in how they're addressing these issues within their kind of portfolios and in their supply chain. And these are three companies that we've recently been working with on a variety of sustainable ag issues. White Wave Foods, you might not know them by that name, but you might know them more by their products. They're a big player in plant-based foods, prepared foods, so the silk, almond milks, soy milks. They also do the So Delicious frozen treats to kind of replace your dairy, not frozen yogurts and ice creams. We have been working with them on palm oil in their products. Palm oil production is a real issue. It has been a problem around deforestation and also human rights issues. Over time, there's been a lot of issues with child labor and forced labor in palm production, and then also not just deforestation, right? The transition of forest lands into monoculture for palm oil has been really detrimental. White Wave had good policies in place by kind of what the best standards were. They had committed to sourcing 100% of their palm oil through the guidelines and criteria and certification process from the Roundtable on Sustainable Palm Oil. But we ran into issues that, those guidelines really weren't strict enough to our standards, and we felt that they still had some ability to improve their practices. We felt that the human rights criteria for getting that certification weren't quite up to what we felt was appropriate, and we felt that there were certain forest lands that were not covered. So we went to White Wave with a proposal that they really move from just that, kind of hitting those RSPO standards to a policy of no deforestation, no peat, no exploitation. So really protecting those lands that are the biggest kind of carbon sinks and protecting people in the process. That was a really productive conversation. We got a commitment from the company to move those standards up, to put some language around it and how they were going to manage that in their supply chain. So that was a victory that didn't have to go to a shareholder vote. Smuckers, we did have a shareholder vote, or we are waiting for a shareholder vote. We're working on a pesticides issue in the supply chain. We're asking them to put together plans for reducing their pesticide use in the supply chain, citing issues around, impact to humans, of course, increased cancer risks, but also impacts to pollinators, as bee colony collapse has been tied to neonics and their use in the supply chain. That vote, it will be up soon, and so we'll see where we go on that. On Whole Foods, food waste reporting. As I said, food waste is a real big issue in just the size and where we are today. And a lot of other food distributors and end-line sales markets have really signed on and committed to reducing their food waste, to creating reporting around where food ends up, making sure that edible food gets to people, whether it's through charitable donation or other avenues. We have coordinated with Whole Foods, because Whole Foods is obviously a leader in the organic space and local food sourcing, but they have really fallen behind peers on broad reporting on food waste. They've been doing it on a store-by-store basis rather than having big, broad policies around this issue. We had a shareholder vote there last year on this issue and received 28% support for our proposal. At that point, Whole Foods said they would work on this, but we to date haven't seen anything. So we're kind of putting their feet to the fire on this issue and have resubmitted our proposal and received a little bit over 30% this time. So a reminder to Whole Foods that this is an issue that investors care about and that we'll be continuing to seek out that data from them. So the next slide is just our website. And again, I encourage folks to go there, pull our report, and you can also look at all of our proxy voting and from an issue area perspective and see what we've been doing in this part of the ESG investment world. Thank you.
So hi there, my name is Maria Lettini. I'm the director of the FAIRR initiative. Thank you, George and IEN, for the invitation to speak, and thank you, Trillium, for such a really informative paper. I really encourage everyone to have a read. Just to give you a little bit of background about FAIRR, we are an institutional investor network. We have now over $3 trillion of investor AUM of support through our membership base and our engagements. We launched the initiative in December 2015, and we are founded and we're funded by Jeremy Collar through the Jeremy Collar Foundation. Now, Jeremy is the CIO of Collar Capital. He has always been really passionate about animal welfare and bringing to the fore the risks associated with the current intensive livestock production method. And so he really recognized that using investor influence is one of the most powerful ways to affect change. And therefore, he founded FAIRR in an effort to transform the current state of the animal protein production market. Next slide, please. So just to give you a little bit of background on the development of intensive farming, and I feel like many investors and other individuals really don't know how this came upon us rather quickly. So, you know, I think we've all been hearing about how the world population has been increasing, and we're looked to have about 10 billion people by 2050. That's a lot of mouths to feed in just 30 years. And, you know, over the past 50 or 60 years, we've seen incomes rising, we've seen increased urbanization, and obviously that's led to increased demand for different types of food as it's become available. Now, to meet that demand, particularly for meat and dairy protein, and also, quite frankly, to prop up a lot of the grain feed prices over the past few years, factory farming was born. And so what we've seen is fewer farms raising more animals, and around about 70% of all animals are produced globally through the intensive farming method. And in fact, 99% of the meat that comes to your table in the US is. So just for example, in the past 40 years ago, there were about 10,000 egg farms in the US. Now, there are only about 200. And obviously, this is creating farms that have thousands of animals. They're in closed, confined spaces, poorly ventilated. Welfare is probably poor. And basically, they're disease incubators. And we've seen this process really originate and grow throughout the US. And now we've seen it also spreading, obviously, to other areas of the world, Europe, and increasingly more now into the emerging markets. China being really a focal point here. And, you know, we've seen a lot of the big companies move in to China quite rapidly, expanding, particularly in the poultry market. So we've seen Tyson moving in quite quickly, you know, building some of the biggest chicken farms in the world. So obviously this has been raising some red flags, at least for us here at FAIRR. Next slide, please. So you might ask, okay, now we have a growing demand for meat. We've created this method of production that produces lots of meat super efficiently, really cheaply. Isn't that what investors want? Well, we like to address this statement with what we call the 4 inconvenient truths of factory farming. Now, one of the things that you may or may not know is this type of intensive livestock farming actually threatens human health. Although you might be getting the meat to your table, the way in which these animals are produced really has been leading to pandemics that, like the ones you've been hearing about over the past few years, like bird flu, swine flu. It's been really increasing bacterial resistance with strains of MRSA and E. coli. And all that has been exacerbated by the overuse of antibiotics in the livestock production chain. So, for example, 80% of all the antibiotics used in the US are used by the intensive livestock production chain. So where you might be concerned that antibiotic resistance is a result of your doctors over prescribing antibiotics, actually that's not the case. The majority of antibiotics produced and used in the US actually go into the food that you eat. So besides that quite scary fact, I mean, we still also have the human health threats of heart disease, cancer, diabetes, obesity, that also really is stemming from the overconsumption of meat protein. When we think about climate change and waste pollution, over 50% of global greenhouse gas emissions stem from the livestock industry. So that's more than even the entire global transport sector. It's a huge contribution, and one that we need to take into account as we consider trying to meet 2-degree limits. And in fact, on the waste side, in the US, we produce 130 times more animal waste than human waste. So this is a big issue, and will continue to be an issue as we think about these risks in the emerging markets, where perhaps these sectors are less regulated. And when we think about food security, with all the grain that we're producing in the world, at least a third of that is actually going to feed farmed animals rather than going into the starving mouths to feed. And it takes actually 6 kilograms of plant protein to actually produce 1 kilogram of beef protein. So that obviously starts a whole slew of questions that might come to mind when we think of how are we using and consuming, the Earth's scarce resources. So as Trillium also mentions in their report, animal agriculture is actually responsible for a huge amount of deforestation around the world. In fact, it contributes to over 90% of Amazon deforestation, either with actually the animal farms themselves or the farms of soy and other grain proteins that are actually there to feed the livestock production. Next slide, please. So when we think about all of the risks that are associated with factory farming, we did so through one of our flagship reports that are launched in December 2015, where we identified 28 ESG risks that are associated with intensive livestock production. So obviously, as an investor, the idea is to avoid these risks, avoid the risk that translates to value destruction that we see on the right side of the slide, with the thought that we as investors or the investment managers that are investing on our behalf can integrate environment, social, corporate governance issues into our portfolio process or address them through our engagement with companies. Now, you see on the right-hand side is a perfectly fine and recent example of how the lack of proper integration and engagement on ESG issues has led to value destruction. So this is the latest in a long line of scandals. This is the Brazilian meat producer JBS. So back in March, I'm sure we've all heard of it, that they were involved in a scandal about selling rotten meat. This meat was sold to local Brazilian consumers. It also put up a giant red flag because JBS is a company that exports meat to 30 other countries. So first day the scandal erupted, we saw a 10% drop in the stock price. We saw a class action lawsuit ensue several days later. We then saw Moody's downgrade the company, the US subsidiary and the corporate family subsidiary, and the company has been put on a watch list for further downgrades. And so we saw a total market value destruction of over $2 billion. And this is also potentially jeopardizing, planned subsidiary IPOs. So these are issues that are absolutely certain that we need to properly address in our investment process. And I think highlight that investors need to inform themselves of the risks and also be able to engage on the risks. Next slide, please. So while this is one example of poor risk management, we try to look at all the risks across the animal protein supply chain. And one of the ways that we do that is encouraging investors to incorporate these risks into their investment process, as I mentioned. But we also do it through collaborative engagement. And in order to highlight these risks with companies, we do have a collaborative engagement on antibiotic overuse in the restaurant supply chain. But we also look to engage with companies on protein diversification. So we have looked at the trends in sustainable protein, and many of you have probably heard of, the rise in flexitarian diets in the Western markets. We're seeing a real growth in diversified protein offerings at supermarkets. We are seeing people more focused on improved health and reducing their meat consumption. And the alternative protein market certainly is growing and looking to double in the next 10 years' time in the US. We even have regions and countries like China saying they need to reduce their meat consumption by 50%. And so on the back of all this changing demographic and changing ideas around protein consumption, we are also looking to engage with companies on what their strategy is for incorporating these changes, not only with consumer preferences, but diversifying their protein offerings. Next slide, please. So, as I mentioned, one way that we're currently doing that is with our sustainable protein supply chain engagement. So this collaborative engagement has 46 institutional investors, supported by over 2 trillion of AUM, and we're engaging with 16 international food companies. Again, what we hope to do is recognize that companies will want to be ahead of the consumer trends. And begin to understand some of the uncertainties in the market in terms of risk to the protein supply chain, be more resilient and future-proof their own portfolios. And we see increased interest from investors in understanding how these global food companies are thinking about these issues. We're in our second phase of this engagement. Some of the highlights from the first phase are really receiving responses from all the companies except for one. Companies really saying that they are beginning to look in this space. They're seeing real increases in meat-free products. They're encouraging consumers to buy non-meat products and positioning those products much more prominently alongside their meat products in their spaces within their supermarket stores. So this is a really interesting engagement, and we're obviously seeing a lot of interest from companies, understanding what investors are interested in and how these trends are going to translate into increased profits and being leaders in this space. And we're also seeing interest from investors, not only to understand what these global food companies are doing in terms of interest in the protein diversification market, but also understanding how they may begin to push the market and what investments might be available to them. Next slide, please. And just to further sort of drive this point home, you know, we've seen big moves from a lot of the companies in this space. So there's been, you know, quite a few high-profile announcements over the past year. We did see Tyson Foods announce it was purchasing a 5% stake in Beyond Meat, which is a plant-based meat company. General Mills has a business development and venture capital unit called 301 Inc. They've also invested in plant-based proteins such as Beyond Meat and Kite Foods. And we've seen, you know, with definite relative success, egg-free mayo really taking off and being in the spotlight of the market for the past couple of years. And this was particularly after the big bird flu outbreak in the US a couple of years ago. So 50 million birds had to be culled. Egg prices actually doubled. And Hampton Creek hugely benefited from being in the right place at the right time, and being able to, you know, supply huge companies like Compass Group and Starbucks with really great egg-free mayo contracts, and really cornering the market in this space. And now we've seen other big food companies like Unilever recently purchasing Sir Kensington, an egg-free brand. And so certainly we're seeing the leaders, big food companies, begin to look at innovation, look at their R&D, and think about how this sector of the market is really moving. So I think there's some really exciting stuff in the pipeline, things that investors will want to learn and know about and consider as these companies begin to scale up. And that's probably a good time to move on to the next presenter to talk about further opportunities. So if you're interested and you have further questions, I'm happy to take them later, or do get in contact later on. Thanks.
Hi, Maria. Thank you. This is Don Wiviott. As Sada and Maria have spoken, there are huge gaps in the supply chains. When we talk about large companies converting their view of the world, when we talk about change in consumer demand, when we talk about basically people becoming aware of the carbon impact of how we produce our food, there has to be step-by-step progress made within the supply chains that support these initiatives. So what we do, and also Sada, thanks for the call out to private equity, is we support individual farmers in Iowa principally. And Dave Miller and Iroquois, that is going to follow me, we dovetail nicely because he works with new farmers and he also gets people introduced in the market. He can speak to that. But our mission is to hit scale. We can place $100 billion in assets with just 10 farmers. Next slide, please. So when we have local farmers and doing vegetables, this is the food that I eat when I go to my local farmers market. And these are gaps in supply chains that Dave can address. Next slide, please. But what we're doing is we hit scale. So when we talk about family farmers, they do have massive amounts of equipment. We do have the ability to hit production. Our farmers need 3,500 to 5,000 acres to hit scale because of the intensity of the equipment. But there is a serious problem within this environment. In order for a farmer to meet the demand in Iowa, his customers are saying, look, there's 4 times the demand than the supply. Next slide, please. But in order for the farmers to get out there and to increase their production, they need equity and they need to be able to borrow money. And that is the gap that we're filling with Sustainable Farm Partners. You can see the growth in the organic food sales as from 2007 to 2016. It's gone from about $1 billion to well over $40 billion in 25 years, and it doubles at every 6 years or less. Next slide, please. So to hit this type of growth in the industry, there are production gaps. Farmers cannot go out and buy an extra 2,000 acres of land because that represents a $16 million investment. So what we've done is we've identified individual farms and farmers, and we are buying land in their footprint so that we can provide them with the extra land that they need. And then we joint venture with the farmers. We don't rent to them. So we wind up doubling the farmer's income. They have the right to buy land from us. We can offer 12 to 14% overall returns to our investors, about half of that being appreciation in the land, and about the other half being in current yield once we've done the organic conversions. So when we're looking at these large corporations, they are buying from grain millers, they're buying from SunOpta. Our farmers are selling to $1.2 billion companies that are desperate for this product. Next slide, please. So the advantage for us is that we have a huge impact on our climate. Everything is certified organic, even though it is production agriculture and we do hit scale. Everything is certified by the USDA. That is in the federal legislation. It's not mandated by the agencies. So when our farmers take a truckload of grain, for instance, to a local mill, they probe the truck 8 different times, they crush the grain, and they make sure that there's no GMO product, and they also test for certain types of chemicals. The other advantage to investors is that we are selling our crops, for instance, a bushel of corn, for about $9.50, and a genetically modified bushel of corn that may have glyphosate all over it or Roundup is only selling for $3.50. And that's because 90% of corn, for instance, in the Midwest either goes to producing corn syrup or feed or fuel. And of course, our corn is all human edible. Because of the value of the product, our corn's going to wind up in boxes on your grocery store shelves. We also only buy land where it rains, and we are eligible for crop insurance. So from an investment perspective, if there are contingencies in agriculture, and there always will be in farming, it is backed by federal crop insurance. The current demand is 4 times the supply. Farm prices are down now because conventional corn has been tied to fuel. So it's a good time for you folks as investors to be looking at agriculture because land prices are lower than they have been in the last 5 years. And then also agriculture as a class is completely non-correlated to the rest of the stock market. So perhaps to the other investments in your portfolio. So within agriculture, which is uncorrelated, organics are also uncorrelated. And then on carbon sequestration, which is why another reason we want to hit scale, We can verify through top-rated science people that have worked with Sandia National Laboratories, some of the state universities, and the Rodale Institute, that we can capture 30 tons of carbon dioxide per hectare. That means if we're doing 11,000 acres of farmland, that's the equivalent carbon offset as if we had built an $80 million wind farm. Next slide, please. And in fact, when you look at it and you're looking at geographic risk, it's easy to do in the United States. You want to buy land where there's 28 to 32 inches of precipitation. You typically want to buy east of that 100th meridian. You can see Iowa is circled. And you want to buy non-irrigated land so we're not depleting aquifers. And of course, we help waterways because we're fighting erosion. We have very little erosion because we restored the soil. Next slide, please. And the soil is at the key to everything. When you are using ammonium-based fertilizers, you basically are killing all of the biology in the soil. Very few people realize this. But what you can do is you can restore the soil. It's a natural process and it's part of the organic protocols. And it gives you, it also produces huge amounts of carbon capture. So this is a win for the farmers. We're doubling their income. They have the ability to buy land from us. It's a win for investors with kind of low to mid-teen returns. And also it takes chemicals and poisons out of our food supply, and it produces huge amounts of carbon capture. Next slide, please. Thank you. And this is my segue to Dave.
Hello, everybody. David Miller, CEO and co-founder of Iroquois Valley Farms. 10 years ago, Dr. Stephen Rivard and myself formed this company, and it was all about health. So I agree with everything I've heard so far. Health is at the center of what we're doing. It is, I think, the reason that the endowment community needs to be more invested into agriculture. Next slide, please. So I'm a monoculture baby. 63 years ago, I was born near Iroquois County, which hasn't changed a whole lot, except that there is a growing organic community in that county. And our company, which started there in Iroquois County, has now funded farms, or financed farms in about 32 other counties across this country. So it is, in fact, the change that we see happen. We started at, what we would call the middle part of the country with the mid-sized family farmer. We continue to do that. We don't advertise our business, so we're strictly an organic finance company. But we have farmers really across the nation coming to us with their opportunities. We're not a trading investment company, so we don't look specifically to buy in a particular location. We are reactive to the farmers and their organic farming business. We're really a non-compromising group. We have not ventured away from organic agriculture. We use that as the moniker for health. And so in 10 years, we have stuck to that. In many cases, our farms are beyond organic. We have focused on pasture. In fact, as I look at this map, we are looking at opportunities for funding in Wisconsin, an organic valley producer, in Kentucky, another organic valley producer, in Vermont, grass-fed beef, pastured operation, and then additional opportunities in Minnesota and in Virginia. So, we are, I would say, 80% of the way toward becoming a public entity. We would love to be able to advertise our business, but frankly, we need tons and tons of capital to keep up with really what is the next generation of healthy farmers. If you look at our next slide, please. So on the funding side, we have two offerings out there. We're a private equity company, so both of these are private offerings. We offer soil restoration notes. This is geared toward helping the transitional to organic years. It's 3 years. It's where the young farmers struggle deeply to transition that land. So buyers of those notes are directly helping our young farmers by us offering discounted financing or lease terms to transitioning organic farmers. And then our primary source of funding is equity. We're a real estate investment trust now, Iroquois Valley Farmland REIT. That was just formed early in the year. So we might be the world's smallest REIT, but we're certainly probably one of the most healthy. We structure the company as a public benefit corporation, and the public benefit basically is public health. So healthy food, soils, and water. Next slide, please. About a year ago, we started doing mortgages. We knew there was an awful lot of capital that was frozen in conventional finance. As I mentioned, we're an organic, a nationally diversified organic farmland finance company. So we underwrite on a different platform. We have a different philosophy. We look much longer term. We look at health. That differs than what conventional finance is doing. In fact, a lot of conventional financing structures are really oriented toward how quick can the capital come back. And if you have short amortization schedules, that really freezes up an awful lot of capital that should be oriented toward growing these organic businesses. So we felt like we had to move into mortgages to really free up the growth opportunity for these young farmers. Now, on the right side, in the generational mix, baby boomers are most of our mortgage business right now. Now that differs from our leasing business, which is 70% millennial. So on the mortgage side, it's a little bit more of an experienced farmer. And so effectively, what we're doing is increasing the credit quality of our overall portfolio by using mortgages. We're well represented to the millennials through our lease programs, which are effectively 100% financing. But the mortgages are usually 75%. So a little better credit. We're effectively subsidizing the lease portfolio by balancing our balance sheet. On the mix between refinancing and purchases, what we've seen in the last year is an awful lot of refinancing, and that speaks directly to what I'm calling as frozen assets in conventional finance. If we advertised, we'd be inundated here with opportunities across the country. We'd like to do that, and that's why we're stepping toward a public offering. Right? Next slide, please. So what can the endowment community expect via return? Our first 9 years, the IRR is 12%. So not too bad. We don't necessarily anticipate that going forward for the next 9 or 10 years. So we're saying 8%, and that 8% is going to be a mix of income and growth. If you look under income at a 3%, you can write mortgages under that because that's providing most of the income. And then growth is our lease portfolio where we own the land and we lease it indefinitely to the farmers. So that's growth of capital. Combined, 8%, historically it's been higher than that. But we think that sustainably speaking, that's a very reasonable number. Same thing with the asset mix, really moving toward more of a balance. Leases currently are 80% or so of our business, and mortgages are about 20%. We probably see that going toward a little bit under the REIT, a little bit more of a classical growth and income mix with up to 60% mortgages, which means 40%, 60% leases, which is owned, and 40% mortgages. So, classic, let's say, growth and income balance between for our portfolio. So we would, health is at the center of this. So it has been from the beginning. Our co-founder is a medical doctor, and this is how we view the trend. It's going to continue. It's not a temporary trend. This change is big. It's billions and billions of dollars of capital. As I mentioned, we started in the monoculture. Effectively, we are recapitalizing a dead soil monoculture, as we call it, and creating a new agriculture with living soils and a much more healthy food system. So I'm happy to answer questions, and I think we're at that point. Thank you.
Great, thank you so much, David, and thank you to all of our panelists. For our panelists, if you go ahead and take yourselves off mute, we'll jump into just about 10 minutes of questions here. And for our audience, please do put your questions in the chat box there in your control panel, and we will get to as many of them as we can here in the next 10 minutes or so. I wanted to start with kind of a quick one, probably for Sada. We had a question about any particularly good resources or academic references for those who might want to research these subjects further. And would it be safe to say that the white paper has some of those, and are there any in particular that you think might be worth checking out?
Yeah, so I would point to exactly that. So if you look at the white paper, there is probably 5 pages of cited resource data at the back there that points to different papers and quite a few data sources that were used in putting this together. Croatan really should get credit for that, because they really brought together a lot of resources across various educational and investment pieces on the issue. It really depends on what you're looking at and where you're looking for data. I would say, Maria's group has also put out information specifically around alternative proteins, and that portion of the space. There is a new paper out on food waste that we also co-sponsored that can be accessed on our website that is interesting on that topic area. But I would, just as a starting point, reference the biography for the white paper, because I think that there's really a lot of good resources and varying resources for different portions of this conversation.
Mm-hmm. Yeah, no, that's a great point. I mean, as we've seen from all of your presentations, there are really a lot of angles to look at this topic from and a lot to cover. So we're only going to be able to scratch the surface, I think, on a couple of them here. But we did have one other question here that I'd like to direct to first Don and then David around liquidity of some of these investment opportunities. And so Don, could you maybe just say a few words in terms of what the liquidity expectations might be for your investors?
You bet. An ideal time frame for what we do, because we have to get through the conversion periods on the farms, which is really 3 years, but that's 3 years in 1 day. So the first 2 years you have some nominal income because we're selling cover crops that are rated as non-GMO or organic transition. So our lockup is about 5 years, but ideally you're looking at about a 10-year investment. And that's to get through the conversion period, and then about a 7-year hold past that. And then we're also working with family offices and other people that are evergreen type investors, where we can do individual partnerships where they can hang on to the land for as long as they want.
And
for Iroquois Valley Farms, originally we offered no liquidity to the investors, and they had to trust us that we were going to build that. And we have, and they've been well rewarded for taking that risk. At this point in time, we have over 300 equity shareholders. We are committed to doing a non-accredited offering by the end of the year, which really steps us toward a public offering within the next year or two. We want to be broadly held. We want thousands and thousands of investors to be invested in us, thereby creating the liquidity that everybody seeks. I will just mention that I do often say there is no liquidity for a dead planet, so keep that in the back of your head. Thank you.
Absolutely. And so, Maria, I also wanted to come back and maybe dive a little bit deeper on the antibiotics issue. As David said, health is really at the center of a lot of this. We talked about how this touches the Sustainable Development Goal around health. And so I wonder if you could just talk a little bit more about the trends in that area. Obviously, there's more and more awareness and I think consumer concern around that. And what can you say about how that might translate to investment risk?
Yeah, so as I mentioned, we also have an investor engagement on antibiotic resistance where we're engaging with the restaurant companies, and we'll be expanding that engagement here in the next few months. And I will say that, we have seen a number of companies respond favorably, and that's largely in part because of the investor interest in this space. Antibiotic resistance has become an increasingly important issue, not only from a health perspective, but also in terms of how are we going to deal with large quantities of animals in a small space without the use of antibiotics. And I think really we need the companies to be at the forefront of this. And so we have seen a number of companies, move to not using antibiotics. Now, one who's been doing that for quite some time is Purdue, and that's a non-listing company. But we've also seen other companies being progressive and forthcoming. And Chipotle, for example, is not using antibiotics. Panera says they're going to be phasing out in 2020. And so, it is possible. And we need further investor support in order to push companies to do this. And, quite frankly, we've seen really good examples of, that it is possible. And there shouldn't be any excuse to, have investors and consumers be at the risk of having antibiotics be, obsolete in the near future. So we have seen some good progress. We've seen Tyson brand products saying they're going to not use antibiotics as of June of this year. We've seen, Subway saying in 2025 they're going to be moving to no antibiotics between beef and pork. We have other companies like McDonald's saying they're going to be phasing out the antibiotic use in their poultry supply chains. In the U.S. by this past year, and in Canada in 2017, and KFC phasing out at the end of 2018. So again, we're seeing companies being progressive on the space, and that's not without the real push of the investor influence. So I encourage all investors to get involved here. It really raises up the issue in terms of industry awareness and the importance for the industry to understand that investors are concerned about these issues. It means that countries can also take a stance, regardless of national level policy. We just saw, for example, Maryland come out, I believe today or yesterday, with a new law limiting antibiotic use, sort of following in the path of California. So certainly we're seeing positive trends in this direction, and we need continued investor support to support not only, we need the private sector to step up here where there might be an absence in progressive public policy.
Mm-hmm. And just picking up on that theme of the shareholder engagement, we had a question about ways to invest in sustainable agriculture in public markets. And Sada, I think you covered that. I think the white paper covers that pretty well. But in terms of having impact in the public markets, it really is that shareholder engagement where I think we can see companies start to change. And so you had mentioned that you look to invest in companies that are doing well on these fronts, but they might still have room for improvement. And so I was just wondering if you could say a little bit more about those shareholder engagement efforts, and in particular, are those companies seeing the potential benefits to their bottom line outweighing whatever costs might come with enhanced reporting or enhanced standards around the palm oil that you talked about?
Yeah, so, kind of dovetailing out what Marie was saying around the antibiotics issue, I think consumer companies as a group, when we're looking at public companies, are ones where we have the most ability to kind of move the dial through shareholder advocacy. We certainly do it across the board in a lot of other industries, but, consumer companies are the most susceptible to kind of public opinion, perceptions of their product. People are buying these, every week and bringing them into their households. So changes in attitude around a company and how they are relative to peers on a lot of issues that are coming to the forefront of consumers' concerns are really impactful to them. So we've been able to engage on these issues and bring it to them as a risk, and certainly in the same way that Maria talked about, risks of, avian flu or risks of rotten meat and how that can just destruct value in your company. We talk about issues like that. We talk about, the perception of your products relative to peers. So when we think about the additional cost of something like increasing your standards around supply chain and palm oil, if you're Smucker and we bring that issue to you and we can tell you when we come in, listen, Unilever's already done this, and we've had, positive conversations with Procter & Gamble, and we have all of these different avenues where we can say that you are not going out on a limb on this one. You're actually trailing your peers on this issue, and this could become a bright line issue for your consumers. I think it's a good impetus for them to kind of start the conversation and think about the risk return on that commitment of those funds to something like that. And I'll give a recent example that kind of ties to the pesticide use with neonics and the potential impact on bee colonies. We had engagement with both Lowe's and Home Depot on that issue on the presence of those pesticides in consumer plants that are being sold in their stores. And Lowe's was a first mover and said, okay, we're going to phase them out. We see this as a potential risk, and we think that there's actually a consumer confidence risk and a reputational risk that goes with continuing to sell plants that have been treated with these pesticides. So we're going to phase out by 2020. Home Depot saw that move, and it was a good starter of that conversation for them to say, okay, we don't want to be, the big box retailer in home goods that didn't make this move. So they, came to Trillium, had conversations with us around how to structure their policy on removing those pesticides and how they could be right there with Lowe's and making that decision proactively to move out of the space. So consumer companies are particularly aware of how quickly they can lose consumer confidence by not really being on the front edge of some of these issues.
Mm-hmm. Absolutely. Well, thank you. We are at time, unfortunately, but I just want to thank our panelists again for starting a really interesting conversation here. There's clearly a lot more that we could cover, and hopefully we will in future sessions. But thank you to all of our participants for joining us this afternoon. If you have any questions about this webinar or other activities happening in the Intentional Endowments Network, please do be in touch. Our contact information is shown on the screen now. And again, this webinar will be up on our website shortly. So thanks again and have a great afternoon.